Hey, good morning. This is Meir Valensky with Driving Markets, driving while talking about markets. At the moment I am driving. I know there's a lot of concern by viewers, whether they're on LinkedIn, YouTube, TikTok or Instagram, that I'm not focusing on the road. But what I do when there's an actual clear passage ahead or clear road, then I just talk into the camera or look at the road and talk as I'm driving. Okay, so this is Meir Valensky with Driving Markets, driving while talking about markets. Remember, anything said in this piece is an opinion only. Let's kick off. So the main event yesterday, let's do some levels first of all. So first of all, the Dow was down 84 points yesterday, closing at 33,045. The Nasdaq was up 14 points, closing at 11,997, and the S&P was down 6 points at 39991. Bitcoin was down over $1,000, and the US 10-year Treasury yield for Dove was running at 3.92%. All right, let's kick off and let's look at what is driving markets yesterday, what will be driving markets going forward. So yesterday, the FOMC came out with its minutes of its January meeting, and the minutes were actually far more expansive and aggressive than investors, traders, analysts were expecting, and that caused a lot of volatility in the markets, indicating that all the governors were in favor of an interest rate rise, but some of them, like James Bullard of the St. Louis Federal Reserve, was more interested or pushing for a 50 basis point rise in the Fed rate. So there is a split in the committee of the FOMC as to where interest rates should go, and we're looking now at a minimum 25 basis point rise in March. There's a 73% chance of a 25 basis point rise by the Fed in March. Okay, and there's a 23% chance of a 50% basis point, but I believe we're going to go for 50 basis point rise in March because they really want to tackle inflation, and it's clear that interest rates are not tackling inflation. They're just not doing the job that they're supposed to be doing, and therefore there's going to be more pressure on the Fed and by the governors within the Fed to be more aggressive. So interest rates in the States looking, in my opinion, at least 6% by June 2023. Remember, inflation is rising. Now, this is to answer Phil's question: how can inflation be rising if commodities and energy is dropping? Quite simple. The manufacturers, the wholesalers, and the retailers are taking advantage of dropping prices within the raw material commodity sector and adding further costs onto it in order to capitalize on those dropping costs and pass it on to the retailer. So retail inflation will go up because manufacturers and wholesalers are just racking up the price or not passing on those reductions in the commodities. Okay, very important point to note there. Regarding equities, the Nasdaq is under pressure because as rates rise, the Nasdaq, being a high risk, high tech sector, will fall. And furthermore, you're going to have inflation and interest rates pulling money out of the market and putting into safe deposits. So in January, net outflows in the States were around about 185 billion. Okay, with only 35 billion reinvested in. So it shows a net outflow of withdrawals from the equity market. Very important point, something to keep an eye on, because that shows overall the health of the stock market and the health of equity funds. Interesting to look at the FTSE. The FTSE has done resiliently well and wants to go up because the FTSE is not exposed to the high-tech sector. And because it's not exposed to the high-tech sector and it's purely based on cyclical stocks, the defensive stocks, therefore there's been a push into the FTSE and it's come out of the doldrums and begun to rise. You could see the FTSE rising more as a result of tech fears, as a result of people, investors, moving out of the tech sector. You could see the index, like the FTSE, rise even further because it's more of a defensive, slow moving index and is not capitalized, has not been part part of the excitement of the high-tech growth over the last 10 years. It's been quite a boring index, but in times of a bear market, in times of an economic slowdown, then you could have the FTSE really moving up and becoming a super defensive index if you're looking for defense and not having a high exposure. Regarding foreign currency, dollar strong. The DXY index, which is a measure of how strong the dollar is moving up and looks like it's going to continue rising as rates come into the fall. So you're going to have pressure on the pound, the euro and the yen. Dollar yen looks like a pretty certain buy. Looks like it's going to go to 140, 145. I've been pushing this for quite a while. Cable wants to go up. However, because the dollar index, the dollar is so strong, and speculation of rising interest rates in the US, where there's not rising interest rates in the UK, then you're going to have a divergence and you're probably going to have a weakening cable. Even though it should go higher, it's probably going to stay under pressure as the dollar moves stronger against the euro and against the pound. Now the euro is going to be under pressure because they've got major inflation in Europe and a recession going on. So even with rising interest rates, that's going to add further to recessionary pressures within Europe. US 10-year Treasury still calling at 4.4, 4.5 yield by June. I think it's going to continue rising as the fear of rates moves up. Intel yesterday announced it's cutting its dividend by 2/3. Okay, massive drop. They're trying to cut costs and they're trying to survive and they're trying to add to their bottom line by cutting costs with more layoffs and a cut in their dividend. That sent the shares down. As regards Tesla and Facebook, Tesla is a big sell at these levels. Needs to go all the way down to 140. For those viewers who think I'm short of Tesla, I'm not short of Tesla. Everything said in this commentary is neutral. I'm not short of Tesla, not short of Meta. I don't hold any stocks. I'm just giving you market commentary. Okay, so Tesla's going to go down. Facebook, I don't like Mark Zuckerberg generally, so I'm always calling Facebook down. I think that's also going to go down to 140, and there's going to be a lot more layoffs in the high-tech sector. The layoffs in the high-tech sector, the service industry, the service sector is short of staff, and they're looking to pull in any labor they can. So that the workforce market is split between two particular areas and arena. Bitcoin, cryptocurrencies, Bitcoin fell yesterday over $1,000 down to 23.8. Can't hold the 25,000 level. Looks like it's going to go down further. Under pressure, if rates rise, you can expect Bitcoin to go down a lot more. This is Meir Walensky with Driving Markets. You can share, subscribe, pass a comment. Also see me on TikTok and on Instagram. Have a good day.